We're very focused on inflation, and particularly the front end of the graph of what inflation is going to do sort of month on month, and whether or not we're going to come down from our peak and how fast. But I think you need to be looking back about 40 or 50 years, back to the 1970s, when we saw an inflation breakout to about 12% at a peak in 1975. But what happened then was inflation came down and then broke out again and peaked at 15% in 1980. And this required considerable changes in direction in interest rates, but they topped out at about 20% in 1980. And during this period of uncertainty, that meant that there was a considerable headwind on equity valuations. So when we're thinking about the outlook for inflation and the likely policy response in terms of interest rates, is all about valuations. What's that going to do to the main drivers of valuations, which of course is the discount rate and the risk-free rate. And during that period of uncertainty, the PE on the S&P was low. I said it was 11.3 times over that period, but it was at that sort of level for about 20 years. So you need to take a much longer perspective. This period that we've had in the last 20 years, which was sort of described as the new normal, another way of describing that is not normal. There's continual support for financial markets, these ultra low interest rates, the injections of liquidity anytime trouble seem to be brewing, happens so frequently. Markets even gave it a name and called it the Fed put. But that's not what central banks are about. So, I do expect to see interest rates staying higher. The market has consistently underestimated and had to readjust where the peak is likely to come. And that means we have to think hard about what is an appropriate valuation to apply.
Right, yeah, and we are thinking hard, and I think we all are. But the problem is for those people who are logically saying stocks look really, really expensive compared to those historical averages, and I take on board everything you said. Despite that, the market is looking beyond the earnings recession, looking beyond a recession, is looking at a time when rates pivot to the downside, perhaps over a longer period. Again, I take on board what you said about those two bursts of inflation and how policy was wrong at one stage in the 70s as well. But in the meantime, we've got a rally, and what are our viewers supposed to do?
Yeah, well, I think in the short term, you need to be pretty cautious about it, and buying the rally, I think is something that is quite a risky thing to do. I think that you've got to really sort of define where you think structural growth is to be found and where you think the rally is just driven by expansion and contraction in valuations. And I think you've got some nice structural growth themes going on in Asia. You've got a reopening story in China, which I think is going to run for a while. If you have a look at where growth is expected to come from in the world in terms of GDP, it is Asia that is the bright spot. And so you've got some good structural underlying growth themes where they are associated with depressed valuations because investors really haven't liked what they have seen. At the other side, in sort of developed markets, and particularly the US, I think you're moving into a period of much higher period of uncertainty. And it's just a reminder also that interest rates, though they have moved up quite significantly in the last sort of 18 months or so, they're still negative real rates. I mean, we still haven't caught up and moved into sort of a positive real rate environment yet.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.